When major banks start predicting the same shocking number, you should listen. Goldman Sachs says $5,000. Bank of America says $5,000. UBS says $4,700 with upside to $5,000. These aren't fringe analysts or gold bugs making wild predictions. These are the most conservative financial institutions on Earth. And they're all pointing to the same target for gold by 2026. But here's what they're not telling you. The reason behind these forecasts isn't just market analysis. It's a silent alarm bell ringing through the global financial system, warning of something much bigger than a simple price rally. Gold has already surged over 54% this year, smashing through record after record. But that's just the warm-up act. What's happening beneath the surface is a fundamental shift that most people aren't seeing. Central banks aren't just buying gold. They're hoarding it at levels not seen in 50 years. That's not speculation. That's preparation. The question you should be asking isn't whether gold will hit $5,000. The question is, what do these central bankers know that they're not telling us? Because when the people who control the money start stockpiling the one asset they can't print, that's not a coincidence. That's a warning. If you're ready for the full breakdown, hit that like button and let's paint the picture. The core warning: economic uncertainty. Right now, as you're watching this video, economists are giving the United States a 39% chance of entering recession by September 2026. Inflation, which the Federal Reserve swore they had under control, is proving stubbornly difficult. Only 13% of economists believe inflation will return to the Fed's 2% target by the end of next year. While all this uncertainty swirls, the traditional rules are breaking down in the gold market. Gold used to move inverse to the dollar, but not anymore. Gold is decoupling, driven by four forces that have nothing to do with traditional market dynamics. Force 1, the Great Central Bank Hoard. The first force is the most important, and it's happening in complete silence. Central banks across the globe are engaging in the largest gold accumulation in modern history. This isn't portfolio rebalancing. This is strategic repositioning for what's coming. China, India, Turkey, Poland, country after country is ramping up gold holdings. Why now? The answer lies in 2022, when the US and its allies froze Russia's currency reserves. Hundreds of billions of dollars worth of assets became worthless paper with a single keystroke. Central bankers worldwide took note. If your reserves can be frozen with a computer command, they're not really yours. Gold is different. Gold has no counterparty risk. It can't be printed, devalued, or sanctioned away. It exists outside the digital banking system that can be weaponized at will. In 2023 and 2020 for combined, central banks added over 1,000 tons of gold to their reserves. This buying spree is creating what economists call a new price floor for gold. Goldman Sachs cites this sustained institutional demand as the cornerstone of their bullish thesis for gold reaching $5,000. It's a mathematical projection based on smart money preparation. Force 2, the de-dollarization quake. The second force driving gold toward these extreme price targets is even more significant: de-dollarization. For decades, the US dollar has been the world's reserve currency. That trust is eroding faster than most people realize. BRICS economies are expanding cross-border payment networks that completely bypass the dollar. Some analysts predict the dollar's reserve share could drop below 50% within the next decade. This isn't just an economic shift, it's a geopolitical earthquake. The dollar's dominance has been the foundation of American financial power for 80 years. When that foundation cracks, gold, as the only truly neutral reserve asset, becomes the obvious alternative. Gold is financial sovereignty in physical form. Force 3, hidden monetary debasement. The third force is inflation, but not the kind you see at the grocery store. This is the hidden inflation that comes from monetary debasement, the steady erosion of purchasing power when governments print money to solve their problems. The Federal Reserve's balance sheet has exploded over the past 15 years. Those trillions of new dollars circulate, inflating asset prices and reducing the value of every dollar already in existence. Gold doesn't get inflated away. It is the measuring stick that reveals how much paper money has been debased. The Fed's recent pivot toward accommodative policies signals growing concerns. As interest rates fall, money rotates out of bonds and savings accounts into stores of value that preserve purchasing power. This is the exact pattern we saw during the 2008 quantitative easing programs. Force 4. Accelerating geopolitical instability. The fourth force is geopolitical instability, and it's accelerating. The Middle East remains volatile. Ukraine drains resources. China and Taiwan tensions simmer. Gold has always been the ultimate geopolitical hedge. During times of turmoil, people choose to hold their wealth in physical gold. These four forces aren't operating in isolation. They're feeding off each other, creating a compound effect. Central bank buying drives de-dollarization. De-dollarization increases inflation pressures. Inflation pressures create geopolitical tensions. Geopolitical tensions drive more central bank buying. It's a self-reinforcing cycle that's just getting started. The supply-side crisis, the final piece. The most chilling aspect of this gold rush is the supply chain. While demand explodes from every direction, supply is hitting a wall that nobody wants to talk about. Gold mining production has increased by only 0.3% per year on average since 2018. Demand is surging by double digits annually, while supply barely crawls forward. This isn't temporary, it's structural. The easy gold has been found. New major mines require massive investment and over a decade of development. Even today's record prices won't translate into meaningful supply increases until the 2030s. This creates a perfect storm. Fundamental structural demand meets a physically constrained supply. Prices must rise. The darker undertone, the bearish call. The smart money isn't just buying gold because they expect it to go up. They're buying gold because they expect everything else to go down. When Goldman Sachs projects $5,000 gold, they're making a bearish call on the entire financial system that gold is supposed to hedge against. $5,000 gold means the dollar has lost significant purchasing power. It means confidence in government debt has eroded. It means the traditional safe havens that people relied on for generations are no longer safe. It's a symptom of monetary system failure. The time for positioning defensively is right now. The institutional consensus around $5,000 gold is a signal that traditional valuation models no longer apply. The silent warning isn't subtle anymore. It's screaming through record prices and institutional forecasts that would have been laughed at just a few years ago. History doesn't repeat, but if you ignore its lessons, it will crush you. The evidence keeps mounting. The fundamental restructuring of the global financial system is already underway, while the mainstream media focuses on quarterly reports. Central banks are quietly positioning for a future that will look nothing like the past. The window for individual preparation is closing faster than most people realize. The question isn't whether these changes will occur, but whether you'll recognize what they mean before everyone else figures it out. If you found this analysis insightful, make sure you subscribe to the Chronology of Wealth for more deep dives into the hidden forces shaping our economy. The Chronology of Wealth, and I'll catch you in the next video. Peace out.